So hello everyone, thank you for coming to today's price action trading class. This is Chris Capre with Second Skies Forex, and so it's being done by FX Street. Thanks to them for recording this. They've been recording a lot of sessions lately, which has been awesome, so thank you guys for that. We really appreciate it, both myself and I think the students as well. Many students have texted me saying, hey, they were glad they got to see the videos. So thank you guys for doing that service. It's much appreciated. And thank you everyone for coming today. So today's class, I got some really good stuff. I want to show you a couple things. I want to talk about, I promised I would go over the gold chart from last week, so I want to go over this and how I took the trade, why I took the trade. So we didn't get time to finish it last week, and I promised I would start with that this week. So we're going to do that. Then we're going to get into, I'm trying to think which ones we're getting into. We're going to get into euro dollar. We're going to talk about a two-bar daily trading range and what that generally means from a price action perspective. I'm going to talk about a silver trade that I took today on an intraday move, and we'll talk about all the reasons why I got in that and so forth. Okay, so we're going to go ahead and begin. So with that being said, normally I start off with some sort of a lesson. And, that lesson could be, about the psychology of trading, about the emotional aspects of trading. And this one is going to be kind of about discipline and breaking through certain obstacles, particularly breaking through resistance to change, or resistance to doing things. I had an interesting discussion both on forexstreet.net and via my article that I wrote about. There was an article I talked about last week. It was on limiting beliefs and how to remove limiting beliefs so that you can build a successful trading mentality. Because before you can really have a successful trading mentality, you're going to have to remove all the limiting of beliefs that affects your trading. You're only as strong as your weakest link, and generally for most people, that is trading psychology. And the interesting thing about it is that the greatest amount of structure or the greatest amount of challenges traders have from a psychological standpoint, it really has to do with discipline and following their system. How many times have you had a system that you were in a trade, the system said, hey, you're supposed to take profit at, say, 60 pips, and then at like 40 or 45, something happened with the price action. Maybe it got a little tentative, and you said, "Oh shoot, it's not going to make it," or it's not going to do it, and so you took profit early. How many times has that happened to you guys? How many times have you said, "Okay, well, I'm just going to give this a slightly bigger stop than usual on your system." Even though the stop is supposed to be, say, 20 pips or 30 pips, you adjusted it to 40. For whatever reason. Or how many times have you, adjusted the position sizing, maybe because you had a loss and you were pretty attached to having your account at a high level and you just had your first big loss and you're thinking, shoot, I got to make that up. And so maybe you increase your position sizing on the next trade and disobey your system. Has anybody ever had any of those issues? Or maybe even taken a trade that wasn't even part of your system. Has that ever happened to anybody? Yes, no? Of course. Is there anybody in here that's been trading a while and that's never happened to? And anyone? Nobody says anything. That just proves, sorry, you have to excuse me, it's hot today, so I'm drinking water and ice right now. No tea. So nobody was able to say, hey, I've never had any of those things happen. That tells you that it's a pretty common phenomena. It's something that happens to everybody, and that a common denominator or a common phenomena in all that is that very few people can avoid or have been able to avoid making these mistakes. So it's pretty prolific. It's something that's, quite dominant. That alone, the fact that it happens to so many people, should be a clue, hey, this is something I really need to work on. This is something I really need to develop. And so Jano says, so what was the question? Were you not paying attention, Jano? The question was, how many times has those four things happened to you? So it was either you took profits too early, even though your system told you to stay in the position, or you increased the stop size. Well, you're 5 minutes late. Well, that's what you get for being late. So, it was a question of, have any of those scenarios happened to you? You used improper position sizing, maybe because you wanted to make up for certain losses that you had. You adjusted your targets, took profits too early, even though your system told you, hey, you should still be in the trade. Or maybe you increased your stop size, or maybe took a trade that wasn't even part of your system. Everybody said that's happened to them. Nobody was able to say, hey, it doesn't happen to me, or it hasn't happened to me. And so that tells you that it's a pretty prolific problem. The biggest challenge that people have on a trading perspective as they're learning how to trade successfully, 70 to 80% of all the challenges that people encounter are mostly on a psychological level. And within that field of all the problems or challenges that they may have, 70+% of that has to do with being disciplined and following their trading system. I can't tell you how many times I encounter people that just disobey the trading system, even though the trading system is completely rule-based. It has all the rules to get in, to get out, when to take profit, when to close the position, when to adjust the stop, what's your target exactly to the pip. All of it's completely rule-based, and yet they still have problems following the system. Discipline and following the system is probably the number one thing that affects people on a psychological basis. And so this is it's probably the biggest hurdle that traders tend to overcome. It either has to do with this is probably the biggest hurdle, and this hurdle could be related to all kinds of things. Maybe somebody, when they hear the word disciplined, they translate it to mean being disciplined, by that fifth grade teacher that they hated, or by, their father or their mother, or whoever, Maybe they've translated discipline into a negative as being disciplined. Well, that's not going to help you in your trading journey. But the bottom line is that this is the one thing, it's probably one of the largest thing that plagues traders. It could be one of the reasons why they're not following their system is maybe the position sizing they're trading is too much. Maybe you losing $500 on a day is not that big a deal. Maybe that doesn't mean much to your salary, to your bank account, to your income. If your bank account was to shrink by $500, would it be a big deal to you? If the answer is yes, then that tells you, where your thresholds are. It tells you definitely you don't want to go beyond a certain boundary. But if losing $500 out of your bank account today or out of your trading account today doesn't mean much to you at all, well, then that tells you, okay, you can definitely take positions where you're going to be risking that much. And so there could be many reasons why people are not disciplined or follow their discipline, but this is something that plagues everybody. Why does this plague everybody? I've said a couple reasons why, but what's the root cause of all this? Any ideas? There's one root cause of all this. There's one common denominator in all this. Tomcat says fear. Anybody else? Greed, inexperience, emotion. Any others? They're all part of those, and all of those could be part of the answer. Genetics. Definitely not genetics, Jano. Bad habits, lack of confidence, human, fear. If there was any of them that, definitely not lack of knowledge. How many times have you known that there was the right thing to do in terms of trading, but you didn't do it? It's not lack of knowledge for sure. So, the common denominator in all this is your mind. It has to do with the mind. The thing about it is that out of all the things that you will ever be working with in your entire lifetime, the most difficult things you will ever be working with have to do with your mind. It's one of the most, because there's no physical thing you can change per se. I mean, you can change your your pathophysiology in your brain. That helps a lot. That definitely helps a lot. You can change your neurochemistry. That helps a lot. But there's so many subtle things about your mind that there's no outside thing for you to manipulate. It's not like you can buy your mind. It's not like you can pay some money and all of a sudden your mind just all of a sudden is better and fixed. It's not like you can, it's not like you can lift weights and all of a sudden your mind has no more problems. The reason why trading psychology and discipline is such a challenging field for people in terms of trading is because the mind is probably the hardest thing that you will ever try to change in your entire life. Your mind, your patterns of thinking, your habitual thinking, your conditioning, all of these things are very difficult to change, and they take work. Craig says yes. I don't think antidepressants will help. In fact, I tend to not recommend pharmaceutical drugs for anything. Pretty much anything. I haven't been to a hospital in 12 years, and I haven't taken one pharmaceutical drug in that entire time. In fact, I can't remember the last time I ever did, and I can tell you I will do everything in my power to never take those. So, but with that being said, the mind is the hardest thing to change. And I'm saying this from personal experience in trading, that we all come up against our personal challenges, our mental challenges, our patterns of thinking, our limiting beliefs. And that is when we say we want to be a trader, we're not just saying that we want to be wealthy and abundant. We're not just saying we want to work for ourselves. We are saying we are going to manage or learn to manage our minds so that our habitual patterns of thinking, our limiting beliefs, all these things that will inhibit us from becoming successful traders, we are going to manage that ourselves. We're willing to take that on. If you don't realize that this is what you're doing, then you're going to have a very difficult time becoming a successful trader. You'll always be looking outside of you for reasons why it's not working. You've probably met these people on the forums before in the chat rooms. They're always complaining about the brokers. They're always complaining about the market. They're always complaining about something outside of them. But nobody forced them to buy or sell. Nobody forced them to follow a trade signal or anything like that. The bottom line is that if you are wanting to become a successful trader, you are really agreeing, whether you know it or not, that you are going to learn to manage your mind, manage your emotions, learn how to understand yourself in terms of your thoughts and conditioning around abundance, around being wealthy, about being disciplined, about being your own manager of your time and discipline and focus and health and clarity. All these things. You're saying, I agree, or yes, I can manage these things, and I'm going to try and do that. These are all the things you have to manage on a psychological basis. The reason why I'm talking about this is because I was talking to a student the other day. Anybody who's in my class or takes one of my courses gets a follow-up session with me, a private follow-up session. We talk about all kinds of things. And this particular trader, she's now living in China. She has no issues with discipline. Zero. She just does it, and that's it. She sent me her trading report, and I looked at it, and I couldn't find one flaw in it. Not one. She followed the system to the T. Every trade that came up, she followed exactly to the T. She had no issues with being disciplined and following the system. Because of this, she's going to have a much faster learning curve and has a greater chance of becoming a profitable trader faster than most people, because this is not inhibiting her. She's just going to follow it, and that's it. I can't tell you that how valuable that would be to traders. If everybody in there had that, like they didn't take profits too early, They got out when the system said so. They got in when the system said so. They followed all the exact rules. I can't tell you how much people's performance in here would probably improve, but I think you all have an idea. I would be willing to bet every one of you has an idea that if you were able to do that, how much better would your trading be? How many more wins would you have instead of losses? How many less mistakes would you have made? Probably a lot. And so that should be a pointer or a cue to all of you what you want to work on. Yes, we all want to learn how to read charts. Yes, we all need to learn a system or a few systems. Yes, we need to learn how to make entries and exits. Those are all real. Absolutely. But guess what? If you're just doing that, the chances of you without doing the other things, the chances of you becoming a successful trader are very slim, because you'll be neglecting one thing, that one tool that is making every single decision on a daily basis. And that's your mind. If you don't address those limiting beliefs or patterns of thinking or emotions or your focus or your clarity on a daily basis, trading will always be an uphill battle. It'll be a swim upstream against the river of your own mind. Does that all make sense? Can everybody see how that might be a useful thing to work on? Yes, no? Boyke says, do you have an article on this? Yes, I do. And then as a component to that, you've probably seen it, Boyke, or at least I hope you have. It's my last article. It's the last article on my site. It's called Building a Successful Trading Mentality. I'll give you the link. And then on top of it, Keith said something, which is see Bruce Lipton's links on Chris's blog post. Keith, can you find that blog post with the links? Bruce Lipton is somebody who talks about the biology of perception, the biology of the mind, and how the model we had about DNA and everything like that was wrong. And so Bruce Lipton was able to, via science, he's an amazing biologist, show us how the understanding of our mind, biology, and consciousness, we had it wrong. And so, yeah, Romus is a very good book. And so Keith will probably go get the links, and hopefully he will. So this will help change your understanding about your mind and consciousness and everything. Okay, I want to answer a few questions, and then I want to get into these trading examples. I'm going to show you some examples of some positions that I took, why I took them from a price action perspective, and so forth. Ganster says, Chris, if there was a second try in a trade that you just got stopped out, and you try again on the same pair because the reason is still valid, is that revenge trading? It's a great question, Gan. My first question is this. You're in a trade, so let me see if I understand this correctly. You're in a trade, you get stopped out, and there's a second try on the trade. Now, on the second try on the trade, Ganster, did you get a new signal? Because my question is, if you didn't get a new signal, how is the previous signal valid? Your previous signal got stopped out. So how is it a valid signal if it gets stopped out? The only way it could be valid is if you get a completely new signal. So maybe I don't need your answer on that one, because maybe I was able to answer all the scenarios. But the bottom line is that if you get a completely new signal, then that second trade is not revenge trading, because you're following your system. Your system gave you a new signal. You're following all your rules. Same indicator readings, that's fishy. How could you have, it seems like it'd be very tough. I mean, there are some scenarios, but it seems like it'd be very tough to get a new signal with the same indicator readings while getting stopped out. It's possible. The bottom line is, if it's a new signal, it's a completely new signal. You got a complete reset of the signal. Then that's following your system. As long as you're using proper money management, you're following your system, It gave you a completely new signal. That's not revenge trading. But if the indicators have not given a new signal, they just look the same as they did when you entered the trade at the first time, but then you got stopped out, I would not call that a valid signal because you haven't gotten a completely new signal. It should be, the reason why you get back in is a completely new signal. So hopefully answers your question. Harley says, but there are times when some discretion enters the trade, maybe modified due to circumstances. That's true, Harley, and generally, that should only be about 10% of the time maximum, maybe 5%. On my fund, we actually list the amount of discretionary trading that we have permit ourselves to do, and it's less than 10%. That means that maximum 1 out of 10 trades should be discretionary. Maximum. And we try and limit it to 5%. Other than that, we're following our system. Boyke says, we need you on psychology for our monthly webinar. You know, I would be open to doing that. I would be open to teaching a once-a-month series on psychology about building a successful trading mentality, all the different, you know, mapping out the mind. I would be willing to do that. You know, that's something that I'm totally open to do. Dry Desert says, if you grind your teeth while doing that, then it is revenge trading. Yeah, that would be one qualification. Okay, sorry about that. It's probably one of the hotter times of the year, so having to drink more fluids. Awesome, Keith. Thank you for sharing that. In that post right there, there's a bunch of links to all the different videos by Bruce Lipton. I definitely suggest watching it. Okay, one of the questions here by Kestis, and then we're going to look onto some price action formations. Kestis says, have you tried doubling up your lot size after a loss? Never. Why would I do that? Why? Why would I go outside of my risk parameters? Why would I do anything? It's just one loss. Have I ever done it before? I've done it in the past. That was a long time ago. I won't do that anymore. That's ridiculous. You're just you've just made a loss, and your mindset is in such a place that you're thinking you should double up. For what reason? Why would you double up to make up for it? Why would you, if you've tested your model of doubling up, like you've mathematically tested, say on MATLAB or a certain algorithmic system, there's many programs you can use to test your risk model. If you've tested it and you have a very large data set of trades and a good mathematical basis for doing that, by all means, do it. If you've tested it over a large data set. But if you haven't, you just saw it as something online and haven't really looked at the mathematics of it, I would not recommend it. Just because something's online doesn't mean it's true. So, I wouldn't recommend it. Now, we do have, on one of our systems, we do employ dynamic risk modeling, but that's a separate discussion. You know, we're now venturing into talking about risk and money management, and I could spend class upon class upon class talking about that. But, from a psychological perspective, no, I don't double up. I just don't make that mistake anymore because I've gone through that experience and it hasn't worked out well as a whole. And, the bottom line is that the more mistakes you make in trading, the more it tends to affect your account. Trading is more about removing mistakes instead of, doing like really good trades. If you eliminate a lot of your mistakes, if you were to eliminate all your mistakes in trading, I would be willing to bet 90% of the people in here would have profitable trading accounts. Steady equity curves. Your greatest dips in your equity curve are more from mistakes than you following your system. Generally, that's more often true than not. Okay, great. So with that being said, I promised to talk about this gold trade, why I took it, how I took it, what was going on with it. This was from last week. I want to complete this. And then I want to get into a trade I took today it was an intraday trade. I also want to talk about the Euro US dollar 2-bar trading range, what that means from a price action perspective. And then we're going to, we'll see if we can get into any more after that. Okay. So we all remember from last week we were talking about Bernanke, how he said, hey, I'm keeping rates at 0 till at least 2014. This created kind of a unique event. It's a very unique event. It's not something that happens, multiple times a year. It's like a once a year thing. I mean, how many times does it say I'm not going to raise rates for the next 5 years? It's a rare event. When these things happen, they tend to trigger a very strong price action response. And it did. Gold, in a matter of minutes, shot up over $50. In about a period of an hour, it shot up over $50. Very strong reaction in gold. Silver shot up. All the dollar pairs started hammering the dollar. We all were watching this last week. Hopefully you were. And we saw the very strong price action response to this. Now, anytime we have a very strong event like this, or even a very strong price action move that is out of the norm, $50 in an hour for gold is quite a unique event. It would be like your US dollar moving 200 pips inside an hour. It's not something that happens often. So when you see these really strong reactions or responses to anything, this should wake you up and say, hey, there's a trading opportunity. Obviously, you want to look for trades in that direction, but what I'm often looking for is I want to look for the first point where the market starts to reject. I want to look at the very first point where the market starts to pull back. Now, Boyke says, why 5 minutes? I have to use the 5 minute on this because my 3-minute charts for FX Trek and telecharts only go back a couple days. And this trade was from Thursday, I think it was Thursday, no, it was from Wednesday last week. So the 5-minute chart goes a little bit further back. So that's why. Normally I would be taking this on a 3-minute, I was taking it on a 3-minute trade, but because the data doesn't go far enough back, I'm having to use a 5-minute just to demonstrate it. So hopefully that explains it. But to be honest, Boyke, it doesn't matter what time frame. It doesn't matter if it's a 5-minute, a 3-minute, a 1 hour, a daily. It doesn't matter. It's the same price action formation. It doesn't matter at all. I'm just showing this on an intraday because there's some subtle nuances I'd like to point out. So I'm often looking for the first major rejection point of that first initial move. This is the first initial move here. You can see it's incredibly strong. Gold is just climbing, climbing, climbing. Then it hits a level at 1703.18 and then pulls back to about, I think it was 1692. 1693.66. Okay, so I marked these two levels. Now, if gold then continues to break out and make a new high, yes, I'm going to mark that level. I don't know why the data set there is. That's strange. That was probably the holiday, or the weekend. Okay, so what I'm going to do is I'm going to mark that high there, and then what I'm going to do is I'm going to look for a pullback to this particular level. If I get a pullback to this particular level, I'm going to be a buyer. Why is that? Well, it's pretty simple. If you have something that is moving so extreme, gold moved $50 in a period of an hour, less than an hour, but then it hit a level and just pulled back out of thin air, well, that tells you two things. It tells you either A, it was a price level where the buyers felt, hey, this is a little extreme, we're going to take some profit before we re-enter the market. So that's scenario A. Or scenario B is the seller said, hey, this is too extreme, we're going to push back a little bit. We believe that this is overvalued, so we're going to enter the market and push back. Either one of those scenarios tells me it's a very critical level from a price action perspective. And that is a very good chance that the market is going to pull back to this level. It's what I often call a gravity point of sorts. We talked about this the last time. So I'm looking for the market to pull back to this level. If it does, I'm going to be a buyer. I actually wrote about this when the price action was up here. I wrote about on my blog ahead of time, hey, if you're an intraday trader on gold, watch for market to pull back to this level, look to buy, and then look to go long. And what did I say? I said target 1750. What did I say? Put your stops just below this swing point here. Well, let's see how this played out. I wrote about this ahead of time. This is not something I said after. I wrote about it ahead of time. What did the market do? Pulled up a little bit higher. And then, I got to zoom out a little bit. There we go. Okay, so here's the 1703 right here. After a little bit of choppiness, look what happens the next session. To start off the London Open. Market pulls right back to the 1703 level, creates a nice pin bar formation telling us after aggressive selling, look at this. This is aggressive selling to start the London Open. The first candle we see is selling, 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 all rejections off the 20 MA. Then the market starts to sell even more aggressive, telling us there's greater participation on the sell side. The market opens, doesn't go up one tick, sells off, hits the level, then rejects off of it completely. Goes sideways, goes right back to the level, gives you a second entry, and then look what happens. The buyers say, guess what? This is our chance to get back in. We recognize this is a clear level. Boom. Market takes off. Can everybody see how that was just an easy trade setup from the beginning? Anytime I see that and I see the pullbacks to this level, especially with the rejection like this, I'm going to buy that. I'm going to buy that, and I'm going to take it either to the prior swing highs, or I'm going to target another key support or resistance level that I already mapped out. The one that I mapped out, 1750. In this case, but in this case, I didn't go for the 1750. I just went for a 2-to-1 in relationship to my stop. Where did I place my stop? Pretty simple. Here was where the rejection was that I talked about. Here was the pullback level. Very simple. Stop just below this, a few ticks below it. Well, that gives me what? An $11 stop on gold. So I need at least a $22 target. Pretty simple. Lenny G has a question. Where exactly did you enter on this level right here? I took the exact pullback to this level. Put it in order here. That was it. It actually didn't trigger until London. Actually, the first hour, first 20 minutes of London. But it triggered. Pretty simple. Stop below that. I had a little bit over 2-to-1 target on that. I think I adjusted it to about 2.5-to-1, which put me at about $25, $26 target. So you're talking 703, or that would be 1703 plus 25. It was about, I think I went to 1727. I'll have to look on my trade log. I don't have it open. But you're talking further up there. And hit it later in the day. Talking right up here. Went to 1730 for the high of the day. I think it even went a little bit past it, but yeah, just a little bit past it. So can everybody see that little formation here? It's a pretty simple formation. Can everybody see? This is the event. This is the unique price action environment. It finally hits a rejection level. This is a key swing point. Pulls back to key level. I mark these levels and look for it to pull back there. I'm a buyer. When it hits that, I'm a buyer. Especially with that kind of rejection, double bottom, great confirmation that this is the key line in the sand. This is not a difficult trade setup to find. In fact, what does it resemble? What other price action formation have I talked about many times that it resembles? Anybody remember? Who remembers? Michael says BPC. What's a BPC? Okay. Yes, exactly. Breakout, pullback, continuation. Exactly. Ganser, Gabriel. Well done to all of you. That breakout pullback or that breakout retest, it works on any time frame. It doesn't matter whether it's a 3-minute, 5-minute, 1 hour, 4 hour daily. This is a classic example of it. Can everybody see how simple it is to find these little setups? Yes, no? Can everybody see how I manage my trade on this one here? Make sense? Yeah? Okay, great. Fantastic. So that covers the gold trade. Let me get a new chart here. So I'm going to pause that one. I want to show you a play I did on silver today. No, not that chart. Okay. Fantastic. Boyke has a question here, and then we'll move on. Does it have to be in the direction of the trend? in terms of that particular move, yes, you want it to be in the direction of trend. But if you're talking about the overall trend, it doesn't have to be. It has to be on the trend on that particular time frame. That move was clearly, that unique event, that unique price action event was clearly on the 1 hour time frame, or the intraday time frame. I saw it there. You could have spotted it on a 1 hour time frame as well. It doesn't matter. But it has to be in the direction of that particular move. Yes. So you want it to be in the direction of that particular move within the time compression that you're working on. But you don't have to say, oh, well, the larger trend on the daily chart is down, so, I can't take, no. You're trading on that time compression. That's where the move has to be. So hopefully answer your question. Dry Dessert says, so after a strong initial move, you would expect that in question percent of cases there would be another move in the same direction. So after a strong initial move, you would expect that in X amount of percent of cases there would be another move in the same direction. Yeah, I do. Especially after moves like that. I believe moves like that. I'm going to buy moves like that. If it was to the sell side, I can expect that the market's going to probably continue in the same direction. Until I've seen a market structure on a price action level that communicates to me, hey, this uptrend is broken down, or this downtrend is broken down, I'm going to keep playing that direction. This goes back to the very first 4 classes I taught were on impulsive versus corrective moves. So what is the pattern for impulsive versus corrective moves? The pattern is an impulsive move, 75% of the time, is followed by a corrective move, which about 70+% of the time is going to be followed by what? Another impulsive move in the same direction as the original impulsive move. And that keeps playing itself out till when? Talked about this 100 times. That keeps playing itself out till when, Dry Dessert? Or anyone, for that matter. Anyone can answer this question. Nobody remembers? Different signals? No. That plays itself out until it's countered with, there we go, FX works. Technically, Marinko also gets it right till the pattern is interrupted, and technically Mish gets it right as well, structure will fail. So, yeah, until the impulsive move in the opposite direction comes through, or we see a structural failure, or we see the pattern is interrupted. There was nothing on there that interrupted that. So I keep playing in that direction. Here's a great actual case in point of 2 trades that I took today on silver of how I waited for the structure to play itself out, or for the market structure to break. So silver on an intraday basis was climbing, opens the London market, it climbs, 2 impulsive moves to the top side, then consolidates a little bit. I was very tempted to call this little bounce off the 20 made, this move right here. I was very, very tempted to call this a lower high. I was super tempted, but I wasn't quite convinced because it didn't have that kind of push, pull back, push, pull back. It didn't have that. It almost felt like it was a continuation of this, this particular downtrend here, or this particular down move. So the market then sells off, pretty much a counter trend impulsive move to the downside, and I say, okay, wait a minute here. Let's take a look at this. 33.76, that's the key swing point from this second leg up. The market breaks it and then starts treating it as resistance. And I said to myself, right in this moment, hold on. I think this is probably going to make a third move, a third leg in this, 1, 2, a lower high here. And so I said, okay, wait for that. Then that to me would be communicating the market structure has changed or has broken or has undone itself. And what did the market do? Boom. Then did that. It said, okay, I've made a third attempt here to make a high here. I've failed. I've made a lower high. It's lower than the previous 2 highs. So if we break below this key swing point right here, then that is a breakdown in the market structure. And so at that point, I'm going to be a seller. And so look what happens. Boom. Very simple trade. Sell on break, You see the market selling off very aggressively. You sell right below this point here. Let me explain stop, limit, entry, and exit on this one. This is a very simple trade setup. Okay, so I have a sell on break here. I can't put a stop right here because the market could easily pull back to this, so I just put it a couple clicks above, 2 clicks above. Now that gives me about an 8-cent stop on this one here. Well, okay, so then you need a minimum 16-cent target on this one here. So that would place me right at here. Well, guess what? That perfectly matches up with the recent swing low down here. Very simple. 2-to-1 R to R. Bam, there you go. Now, out of the trade. I'm out of the trade, which means that I no longer have a bias long or short. I only have a bias based on the structure. I follow the structure, whatever the structure says, and that's it. So, alright, now let's take a look at this. Market then gives me another clear signal. This sells off very aggressively. This is the most impressive and impulsive move inside this entire play here. Most impressive and impulsive, hands down. But then the market rejects, bounces a little bit, and look what the market does. Bounces a little bit, and then comes right back to this same level. Anytime it comes back to that same level, which is by producing either an equal low or a higher low, then I am looking to become a buyer. I'm going to look and say, okay, we've produced a higher low. That means that if it breaks a key swing point, I'm a buyer. Well, what's my key swing point? Same swing point as was before, 33.70. So look what I'm looking to do. It's not this one right here because I got this resistance level right above here. So it's looking for it to break that. That's my key swing point. Well, if I'm going to enter there, where can I put my stop? I have two choices. I can put my stop just below this low or this low. Here's the problem with this low. If I put it below this low, that creates a 16-cent stop. I need a 32-cent target. A 32-cent target puts me at $34. The market hasn't made that high today. So I need to find a tighter stop. Well, just around here, 60 cents, 11 cents, means I need a 22-cent target. That puts me at what? 91, 92? There we go, 92. Matches up with prior swing high. I shaved it off by 2 cents because I said, you know what, I think it's possible it might get stuck here. I'll be honest, I didn't go for this high rate over here. And look what the market does. Makes a higher low, pulls back to here, uses this as support, breaks the swing point. I'm now long. I'm a buyer on break of that. And then look what happened. Here's my long, pulls back to the 20 EMA. I've talked time and time again how great the 20 EMA is on pullback. Boom, curves up right up to the 90 level. So can everybody see how and why I made those two trades, all based on the market structure breaking and then taking the reverse of that? Yes? No? These price action formations, any time frame, 3-minute, 5-minute, 15-minute, 1 hour, 4 hour, daily, doesn't matter. It's the same formation. If I see them on a 4-hour chart, I'm going to take it. If I see it on a daily chart, I'm going to take it. Okay, great. So let's see a couple questions. And then I should have enough time to get into my Euro-US dollar talk. Okay, Michael says, can this be seen as a break of the trend line, a retest and continuation? I'm not sure what you're talking about there. So, i.e. continuation equals reversal. Talking about my first trade of silver. What about my first? Okay, so let's go back to my first trade in silver. You're talking about my sell. You're saying, can I see this as a break of the trend line and retest? Break of the trend line, retest, and continuation? You mean like breakout retest? Is that what you're talking about? I didn't quite trade it that way. I didn't trade it as a breakout retest. I traded as a sell on break. I felt like, okay, this is the low for the day. This is a key swing point. If the market breaks this, it's probably going to continue selling off for the day. So I didn't take this as a breakout retest type thing. That is something I'm more of looking for a very critical support or resistance level to use that. So hopefully I answered your question. Dry Desert says, if I could see that without the explanation, that's another question. Take some practice. All things take practice. All things take practice. But all things with practice can generally be achieved. So with the right amount of practice, you keep coming to this class again and again and again, seeing me put up these patterns again and again and again, you'll start to absorb them into your nervous system, your central nervous system, and eventually you'll see the same thing, and then you'll be like, hey, I remember this. I remember what he told me to do in this situation. This is where I do this. And then you're going to be a buyer or a seller in that moment, and you'll try it, and it works out. And it's just going to be a matter of practice. Absolutely. Okay, Jez says, what's the difference between price action setups and a system? This is an excellent question. A system has it depends on the nature of a system. It could be a discretionary system, which means it has some rules to enter and exit a trade, but then some of the variables are ambiguous or discretionary. It can be completely black box. To answer this question in a way that makes it to elucidate the differences, I'm going to talk about a price action setup and a system. And when I talk about system, I'm going to talk about a rule-based system, such as a rule-based system where all the rules are explained out. Hey, you need variables A, B, and C to take, the trade. If A, B, and C come up, you're going to go long at such and such price or such and such break or such and such this. This is your stop. This is your limit. This is your entry. This is your exit. This is where you take profits. It just stops. That's a rule-based system. I generally recommend as much as possible trading rule-based systems as much as possible. Now, what's the difference between a price action setup and a system? A price action setup can be a system, but not all systems are price action setups per se. So in the sense of, you could have a rule-based system that is a simple price action setup. It could be a 1-bar formation, a 2-bar formation, a 3-bar formation. That's a price action setup. And it could be a rule-based system at the same time. If the rules are completely delineated, hey, bar A's got to look like this, bar B's got to look like this in relation to bar A, bar C's got to do this in relationship to B or A, that's a rule-based system and a price action setup. But you can have a price action setup that is not a rule-based system. How so? Well, sometimes price action setups, like in this case, have many moving parts. I have this leg up, I have this leg up. Is this a leg up? Open to interpretation. Okay, fine, we know officially that this is another leg and it's a lower high. So I can clearly say from a rule-based perspective, hey, I have 1 high, 2 highs, lower high, key swing point, low of the second pullback. Okay, so that's my key swing point, and I trade a break on that. That can be a rule-based system. But there's a lot of moving parts which make up all these components. And so a price action setup it can have a lot of moving parts that are not fixed. And they can look like all different kinds of things. They can look very different from one to the next. That's why I recommend trading more rule-based systems than having a lot of discretionary elements. Because when you have a lot of discretionary elements, it's going to be hard for you to isolate the variables to say, okay, well, I've traded this system 100 times and, I'm barely profitable. Well, that doesn't tell me much. How did you define your key swing point? How did you define your, third lower high? All of those are open to debate. Who's going to be able to answer that question better? The person with more experience. Because they've seen more patterns, they have more experience, they've taken in more data. they're going to be more comfortable asking those or answering those questions. But as you're learning to trade price action, as you're developing it, that's a much tougher decision for you to make in real time. And if you're having to make that decision on a 3 or 5 minute time frame as opposed to a 1 hour and 4 hour time frame, that's a much tougher decision to make. You have to make that decision really fast. So I recommend starting off with, if you are in the beginning stage, developmental stage, or still learning to trade price action and be consistently profitable on it, then I would recommend starting off with rule-based systems. The more discretionary elements you have to make when you're starting off, the more difficult your trading process is, the slower your learning curve is. But the more rules there are to define those particular setups and everything like that, it'll be much easier to make decisions. I also recommend, if you're in your earlier developmental stages or still learning how to trade profit with price action, start with 1 hour, 4 hour, and daily time frame. You're not going to be so rushed to make a decision. They're going to look a lot cleaner. You may not have so many wick violations of it. They're just going to look a lot cleaner, and you're going to have a lot more information in the sense of more price data. You know, in a 5-minute candle, I'm only going to have 5 minutes worth of price action data. But in a 4-hour candle, that's a lot of data. That's a half a trading session. It's a lot of players that have made plays to create that 4-hour candle. A lot of decisions. That's the total sum of 4 hours of decisions. That's a very different thing. So, does that answer your question there, Jez? Does that give you some ideas as to what the differences are? Fantastic. Okay, great. Boyke says, did you use indicators in my young days? Believe it or not, the first trading I ever did was price action, but I did it off a line chart. I traded off of a line chart. And then later on, about 6, 7 months in, I started to use indicators. So yeah, in my younger days, I used indicators. And then, you know, it just depends, you know, how I was doing it. You know, I was able to compartmentalize my trading. You know, I was able to build systems very early on and then say, hey, for these systems, I need these indicators. For my price action trading, you know, I'm not using them. But yes, definitely I did. KO says, I'm on the same setup trade along on a USD Swiss. Cool. Let me know how it works out. So it's a great price action setup. Once you learn how to use it, it can be a very, very powerful tool in your toolbox. Dry Dessert says, if you have your rules so defined that a computer can follow it, then it's a system. If you have rules that require you to make decisions, then it's a trading framework. I'm gonna disagree with that in the sense of the Dry Dessert, because you can have a system. Computers don't necessarily define systems. The definition of that, the fact that a computer can trade it, I wouldn't necessarily call that the be-all, end-all of whether it's a system or not. You can have discretionary systems. It's still a system. So, you know, it really depends. You know, that's a very, I would call that a rigid definition, and I tend to have a more flexible definition of it. But I'm open to that perspective as well. Michael says, I guess your first trade in silver could be seen as a trend line break of the up move or a head and shoulder formation. I don't look at it as a head and shoulder formation. If it was a head and shoulder formation, I would need to be drawing this line now, wouldn't I? But that's not what I was doing. I didn't care about this low right here, and I didn't care about this low in relationship to this low. Also on a head and shoulders pattern, I'm going to be very concerned about the left shoulder in relationship to the right shoulder. I didn't care about any of those. All I cared about was this swing low point here getting broken. So you could say, you know, you could say what you were saying there, but I'm not going to define it like that. I'm just defining it as a market structure break, taking out a key low, and I'm a seller on stop. Hopefully I answered your question. M. Harris says, gold is coming down as we speak. Would you still continue buying if it reaches 1702 again? No, because we've developed a completely different market structure since then. Developed a very different market structure. Oh, I got too many lines there. Give me a second. Wait, I'm looking at silver now, not gold. So, let me get to gold. yeah, no, I have to take in the fact that there's a new market structure here, and then I need to start looking to those levels again. So, that level, because it's on such a short time compression, that level to me tends to, have a certain half-life to it, if you know what I mean. Kind of like cells have a half-life, radioactive cells have a half-life. I'm not going to say that is a key level ad infinitum. The market's, I'm going to look at the current market structure. How's price action related to since then? And then I'm going to start looking at key levels in relationship to that. So hopefully answers your question. There was actually a similar setup right over here, though. Low, lower low, higher low, market structure break, takes out a key swing point, which also was kind of a key point right over here. Boom, market takes off. So hopefully answers your question. Okay. Fantastic. All right, great. I want to talk about, and I can just go straight to it. Okay. This is a trade setup that I actually wrote about. So, your US dollar has been climbing for a while. It creates a pin bar formation. Last week I talked about how I traded this on an intraday time frame, how I played the trade. Then the market closes up and has a very strong close. What was interesting was how the market responded yesterday. So I want to look at the most recent price action. I want to look at this from a daily perspective here. This market opened, didn't go one tick higher, which means that the sellers dominated the order flow on open. If the buyers were even present in any sort of strength, they would have been able to push price up a little bit, but they couldn't even do that, which means they were not present at all from the open. The market then sells off and goes just one pip lower than this one here. The low in the day here was 30.77. This one 30.76. But then look what happens. The market then rejects to close at 31.42, which is about a 70 pip rejection. So it opened. Let's go over this candle real quick. I want to look at these two candles very clearly. It opens at 32.24. It drops about 150 pips from the open and then rejects 70 of those 150, almost half. Almost half. What does that communicate to you from a price action perspective? Any ideas? None whatsoever? Weak bears? I wouldn't say weak bears. They were able to sell it from open, take out, all of yesterday's price action. Weak bears compared to bulls, so I wouldn't say that. Supply and demand are equal. I would not say supply and demand are equal, per se. Buy strong, even, equal. Today gonna be a red candle, line in a stand. Okay. I'm in 085, and Michael, you two guys. Very clear lines in the sand now, isn't there? This bar is virtually inside all of this bar. It only went one pip below it. So we can pretty much call that even Steven, right? Which means that there was very clear buyers here. Clear enough that they were able to reject it 70 pips. So what does that tell us? This thing closes inside this bar, even though it went one pip below. So it's not an inside bar, but because the low was pretty much so exact and precise as the other one, and the high was only 3 pips off the high of the other one, this is called a 2-bar trading range. We have a 2-bar trading range. It's where 2 bars are pretty much the exact same in distance. One's a bull bar, one's a bear bar. It creates a 2-bar trading range. I generally only apply this on the 4-hour and daily time frames. It's not really that important to me on a 5-minute, kind of meaningless actually. But when am I concerned about this from a price action perspective? Well, if I have a very strong trend, and then I have a bear bar at the end of that trend that creates pretty much the exact same low as the last bar in the uptrend, and the high is pretty much the exact, give or take a few pips within the high of the previous bar, then I call that a 2-bar trading range. What it tells me is there are very two clear lines in the sand, and that the next trading day is going to have a hard time breaking both of those breaking both of those lines in the sand. So that gives me an opportunity to play both lines in the sand. Now, generally, since this is an uptrend, if I see a 2-bar trading range, well, since this really never broke the low of this bar, it broke it by 1 pip. But that's not much at all. On a daily chart, that's meaningless. So, if it had broke it by 15 or 20 pips, then I would say, okay, there's a good chance that this is going to continue on down. But it never really broke it. 1 pip. So you're not going to see technical models get short on this. You're not going to see day traders get short on a 1 pip break of the higher low. So because of that, what's going to happen is that this communicates to me there are no new sellers in the market. That means the market's probably going to return pretty darn close to the high of the prior day. It's going to make a second attempt to try and get to these highs. Maybe even, it might try a breakout. Unlikely though. Unlikely. This is pretty strong selling from begin with. The sellers dominated this candle for the most part. So that means if it gets back up here, there's a good chance it's going to reject off this high. I wrote about this yesterday before this candle, like at the close of this candle, a half an hour after this, I wrote about this. Several hours later, it did exactly what I said it was going to do. And so it tried to make a new high, it failed, and then offered a great opportunity to short it. Why? Because the bulls are still in control. The bulls have been in control of their uptrend here. This is a pretty large move. Sub 2650 up to 32, 600 plus pips. They run into one selling candle. If this candle had taken out the prior lows, the bulls would have probably, the medium and long-term bulls that were in this position would have exited their position. But it didn't do that. So they're going to retry and take out these highs again. Plus, on top of it, we never took out the lows of this enough to add on new technical shorts. So guess what? That gives me more impetus that it's going to retest the highs and likely play inside this trading range here. It's a very good chance the price action of today's candle is going to play inside this trading range. And when we look at it from a 4-hour perspective, these are the two lines. Look at what happened. This is, okay, today's the 31st. So here's the price action. I wrote the article, I think it was on this candle, and I said watch for a retest of the prior highs or look to sell right at 32. I even wrote it. You can check the article on my website. I'll even give you the link. I said look to sell just short of these highs. One of the best places to do that is at 132. And then look to sell it and look for the market to go back down to these levels down here. Pretty darn close. So when I see these types of setups, I'm going to be a seller. The 2-bar trading range, especially on a daily chart, I'm going to look for a pullback to the prior high, fade it just short of that, and then I'm going to be a seller. And I'm going to look for the market to go back down to this range. Here's the link to the article. So, pretty simple trade setup now, isn't it? Not too complicated. For those of you that were buyers, there was a great pin bar signal right here off the low. Could have played right off the 20 MA and gone right back up to the 32 range. So you had both options to play here. Alright, so can everybody see that? Can everybody see this trade? Why I took the trade? In terms of the stop, I even wrote about it on the blog. Put your stop just above this here. You have a 30 pip stop. Look at your target. Your target is about 130 pips. That's what, 4 to 1? Very easy. It's a no-brainer setup. So can everybody see this? Can everybody see how I was a seller on this? Why I took the trade? Okay. Now this formation, I tend to play this on daily charts or 4-hour charts. 1-hour charts is not my favorite. 4 hours and dailies on this particular, anything lower than 4 hours, I tend not to find it that effective. you can have two 5-minute candles create something like this, and they generally don't mean that much to me. You know, it can be effective, but you have to be very precise, a lot more finite. You know, and so with these little daily setups, they're no-brainer trades. But I look for this as a 2-bar trading range, and this is how I tend to play it. Okay, so let's see some questions here. Dry Desert says, would you expect a flag and sideways trading followed by a continuation in the uptrend? I don't necessarily think that far out in the sense of, you know, it could turn into a flag. You know, I'm looking for the next day's price action, and then I want to see how that price action plays out, and then from there, I'll make my decision from there on out. It's a day-to-day thing because I just see how the price action is for that day. You know, I try not to say, hey, it's going to do this for the next 5 days or something like that. You know, markets can change at any point in time. I need to have a very unbiased perspective about it. So I just trade 2-bar trading ranges like that. That's how I make my plays. Manoj says, whether it broke the low depends on broker anyway. That's true. That is absolutely true. And so to give yourself a little bit of room, you know, give yourself a couple pips, you know, 2-3 pips, you know, depending on the time frame. Now, one thing I would like to say is, in terms of this particular setup, since we're using a daily chart, I recommend using New York close. That's a real 5-day trading week. So that's what I recommend on this. If we're talking about an intraday time frame, might be a little bit different. But if you're using a New York close, most brokers are going to have maybe 1 to 3 pips variation from this daily close. You could have 5 brokers with all New York closes. You're probably not going to see much variation in that. Maybe 1 to 5 pips on the top side, 1 to 5 pips on the downside. Dry Desert says the range is also wide enough to allow trading range. Exactly. I don't know if that is smart, but it's what your brain comes up with. Yeah, you know, trading a range, the R to R's have to make sense. Anytime you take a trade, the R to R's have to make sense. This does make it wide enough for us to take advantage of that. So hopefully I answer your question. Boyke says you said TR up but is down. You said the trend is up but is down? When did I say the trend is up but is down? I don't remember saying the trend is up and is down. So I'm not really sure what you're talking about. Dry Desert says, my question of range trading was answered, I guess. Okay, great. Gabriel says, is it the same for a buy on the low of the range? It's an excellent question. I tend to say it's not my favorite. I would rather trade the pullback to the high. Why? Because let's go back to the daily time frame. You can do it. It's just not my favorite. If I had to choose between the two, I'm taking the pullback here. Why? Well, look at yesterday's candle. The sellers were dominant from the open. They started the week off selling from the open. They ran into yesterday's low. It did reject 70 pips. But if the market then opens right here in the middle of the range, goes and retests the highs, fails short of it, and then sells off, who's in control? The sellers are then in control. The sellers have now used 2 bars to establish they're in control. Does that make sense? Now, if it had opened and then gone to this level first, and it had done it in a very timid corrective fashion, then I'd be thinking to myself, you know what, I can take that play. But because the market opened, went up first, and then made a lower high, and the sellers have been able to sell it all the way from today's high at 32.11 all the way back down 140 pips, they're in control. So I would not want to be a buyer in that case. Does that answer your question, Manoj? Or which one was it? Sorry, no. Gabriel, does that answer your question? Hopefully it does. Okay, great. Paul says, my 4-hour bar is closed anyway. Why yours doesn't close it? Because we're working on 2 different server times. So the way my data feed goes, you know, not all brokers are going to be on the same server time. My broker that I'm using for this class is a New York close, and the 1-hour candle starts at 4 a.m. New York time, 8 a.m. New York time, 12 p.m. New York time, 4, 8, 12 repeat. So that's why. Hopefully answers your question. Okay. Let's see. Michael says, how often do you tend to see these 2-bar ranges? Lots of times. One on dailies, on 4 hours I see it. Again, on 1 hours, I'm going to need to see a pretty dominant trend. And ideal is if at the end of that trend, I've seen kind of a climactic bar, at the end of that trend move, then I would consider it. But you're going to see plenty of these on the 4-hour daily. Let's see here. Manoj says, Chris, could you tell us how many instruments you focus on? That's a great question. It really depends on the day. The first thing I do is, I open up my charts and I just do a quick scan of each chart. It could be 3 seconds, 5 seconds, maximum 30 seconds. I just do a quick scan of the chart, look at it on the daily, look at it on the 4-hour, see how the market's moved as a whole, get the gestalt, and then see if there is anything that I like there. And so with that being said, right now, I'll tell you the pairs I'm looking at. I'm looking at Eurodollar, Sterling Dollar, Kiwi Dollar, Aussie Dollar, oil, spot gold, spot silver. But that's me. I've had a lot of practice at doing this. I've been doing this now for almost 11 years. So, I don't recommend that for everybody. But, it just depends. Just depends on your skill set, your ability, how long you've been doing this. It's important that you can feel comfortable reading this thing. Start off with a few instruments, then build your arsenal a little bit. That's my recommendation. Okay, I'm going to say, would a sell stop at 30.70 be a good idea? It's not a bad idea. I'm a little tentative of it. If I'm going to play it, I'm going to look at it, say, on a 4-hour time frame. This is a very aggressive candle. This is a very aggressive candle. So trust me, it's very tempting to want to be a seller at this point. You can do that. The real question is you have to ask yourself is where are you going to put your stop now? That's the tricky part. Where are you going to put your stop? And also look, there's prior price action right here. Now, if there was a lot of distance between, say, a prior swing high and this low, I would probably be a little more tempted. But there's a prior swing high here. As I zoom out, you'll see it. So that makes me a little more apprehensive. Why? Because it gives other layers for buyers to get in. And so buyers are going to know, hey, there's going to be some short-term traders that are sellers on stop here. They probably sold at 30.75, 30.74, 30.73. And if this thing goes back up, they're trapped. And buyers have 3 opportunities to get back in, 30.62, 30.45. They have several opportunities to get back in. So it's not my favorite. Now, if this price action wasn't here, and this was more of a straight line, then I would say, yeah, I would be much more interested. So hopefully answers your question. It's not my favorite. I would want to see a different setup. Rahul G says, how many charts do you look at one time? That's a great question. Technically, all I can really look at is one chart at the same time. It doesn't help me to look at 5 charts at one time and try and multitask. The bottom line is if you're focusing on one chart at that particular time, all your concentration, awareness, and intelligence will be applied to that chart. Now, I am looking at several instruments, but when I'm trading, I'm only looking at one chart at a time. That doesn't mean I can't be in multiple trades. I can be in multiple trades at one time. But when I'm doing it, I'm only looking at one chart in any given moment. I look at it until I need all the information I need, and then I can move on. I don't try and switch and switch and switch and switch. That just creates a very fragmented way of thinking. So does that answer your question, Rahul? Okay, cool. Fantastic. Well, Boyke, trend is a matter of time frame now, isn't it? I can say, well, aside from this impulsive bar right now, I can say the overall trend is up. Aside from this impulsive bar right here. It's possible that this impulsive bar is adjusting the structure of the entire trend. Trend is really a matter of time frame. It's a matter of time frame and perspective. If I say the larger trend, I could say the larger trend is down. But in regards to this, that's an impulsive move. This is a trend without a doubt. It's very strong. I would not call this a corrective move by any means. This is a sharp angle. So this move right here, I would call this a trend. Is the market structure breaking? It's looking like it. And if it does, then that's going to disrupt the trend. So it's really a matter of perspective now, isn't it? All right, last few questions, and I want to wrap it up here. Tomcat, I think I've answered your question. Let me know if I have. Okay, let's see. Dry Dessert says, Chris, do you agree with the statement that the price very often goes down faster than it goes up? I would not say that's a myth. I'd say it's completely true. Price tends to sell off faster than it buys up. And it's not a question of physics, because the bottom line is gravity isn't present. It's not a physical force that can pull on price. It's because of psychology. The bottom line is that the nature of psychology and how we tend to buy and how we tend to sell means that the markets tend to sell off. It's not just across currencies. It's across commodities, futures, equities. They all tend to behave according to this law. They tend to sell off faster than they buy up. Why? If you're long an instrument and the market starts selling off aggressively and you own that instrument, there tends to be no hesitation. Hey, I'm out. I've already made a bunch of money. Why risk losing too much of this money? So I'm out. And that usually tends to, the nature of selling tends to incite fear, and that fear tends to incite a very quick reaction and response from us. So that quick response tends to create, very fast decisions. Boom, boom, boom. Okay, we're out. That's it. And that quick selling tends to create much faster price action to the downside. But if you're thinking about buying something, whether it's a currency or whether it's a car, you tend to take a little bit more time, research your decision, say, hey, if I'm going to buy this, if I'm going to get this, I want to make sure it's going to go for a run. I want to make sure I'm going to get involved. So the overall nature and psychology of how it works out is that buying and bottoms tend to take far longer to form than tops. So, and follow-up question to that is, can the faster selling be exploited? Absolutely. Gabriel says maybe a breakout retest downplay. Not so much, because we've already kind of created a 2-bar trading range, and it's not a key significant level. It's a level within a larger range. So to me, not so much. Let's see here. Michael says, will these price action setups be in the book? A good majority of them will be, yes. There'll be some things in there that I haven't talked about in the classes, some things that I have talked about before, new stuff, old stuff. Yes, there's going to be a lot of stuff in the book. We originally were doing a book on price action and pivot points, but it was becoming so large that we had to split up into 2 books. As we split it up into 2 books, I talked to my publisher and I said, hey, I'd like to split this up into 2 books. He actually even suggested as well, and we said, okay, let's do it, but we're going to change the structure of the book. We're going to start off with the first book on price action. And I said, well, you know what? I also got a lot of brand new quantitative data on it, so can I put that out? Can we include that in the book? And he said, yeah. So we've changed the structure. We've decided on the new structure. Now I'm getting back to writing it again. So I'm hoping that the second time around will be much faster. It's a great structure. I'm looking forward to it. Very exciting stuff. All right, that's pretty much it. So I want to thank you all very much for coming. I hope you guys enjoyed this class. And one small request. And then that's pretty much it. Simple, easy. If you enjoy our work, if you enjoy my price action stuff, if you enjoy these classes and this material, then please take a time to go to this link. If you haven't already, like us on Facebook. We appreciate it. It's a way of you guys saying, hey, yes, we do like your stuff. So I appreciate it if you guys do that. If you don't, no big deal. You don't have to. But all you have to do is just click the like saying, hey, we like you on Facebook, saying, hey, thanks to you guys. Other than that, if you guys have any questions about what we do, check us out at secondskiesforex.com. And until then, I bid you all adieu. I'll see you guys next week. This session was recorded, so make sure you come back throughout this week, watch it again and again and again. And so, any questions or anything like that, make sure you watch the video again. I'll see you guys next Tuesday. Until then, good luck trading. Take care, everyone.